Today, we're diving into Canada's new mortgage rules for 2024 to 2025, a topic that's been creating a buzz in the real estate market. These regulations have been introduced to address the evolving economic landscape and ensure stability in the housing sector. Samantha Brooks, Chief Executive Officer and founder at Mortgages of Canada, recently discussed these changes and their implications for homebuyers and the real estate market at large. One of the key elements of these new rules is the adjustment in stress test requirements. The stress test, designed to assess borrowers' ability to make mortgage payments under higher interest rates, will see some modifications. The aim is to make it more reflective of the current economic conditions, allowing for a broader range of potential buyers to qualify for mortgages. This change is expected to open up opportunities for many Canadians who previously faced challenges in securing a home loan. Additionally, there is a shift in the amortization period for insured mortgages. The maximum period has been extended, providing borrowers with more flexibility in managing their payments. This extension is particularly beneficial for first-time homebuyers, enabling them to spread out their payments over a longer period and potentially lowering their monthly financial burden. Furthermore, the rules introduce stricter guidelines for lenders, focusing on risk assessment and borrower verification processes. These guidelines are intended to prevent risky lending practices and ensure that borrowers have the financial capacity to meet their mortgage obligations. This move is seen as a preventive measure to maintain the stability of the housing market and protect it from potential downturns. Samantha Brooks emphasizes that while these changes are generally positive, they also require careful navigation by both buyers and lenders. It's important for potential homeowners to understand the new requirements and seek professional advice to make informed decisions. For lenders, adapting to these rules will be crucial in maintaining compliance and continuing to offer competitive mortgage products. Overall, the new mortgage rules for 2024 to 2025 reflect a balancing act between providing access to homeownership and maintaining market stability. As we move forward, it'll be interesting to see how these regulations impact the housing market and the broader economy. Stay tuned for more updates on how these changes unfold and what they mean for you as a homeowner or potential buyer. The mortgage landscape in Canada is on the brink of what some are calling a mortgage war, as banks prepare to compete aggressively for renewals at lower rates. The heads of Canada's top banks anticipate that many mortgage holders will be able to renew at more favorable terms over the next couple of years. This is partly due to the fact that interest rates, which had been kept high to combat inflation, are now being reduced by the Bank of Canada. Dave McKay, the Chief Executive Officer of the Royal Bank of Canada, highlighted that around 60% of the bank's customers will renew at lower rates in 2025. He also noted that among those renewing at higher rates, 80% are expected to meet the requirements of the industry's mortgage payment stress test. This indicates a significant number of Canadians will be able to manage higher payments, reducing the risk of financial strain. Raymond Chun, the Chief Operating Officer of Toronto-Dominion Bank, mentioned that about one-third of the mortgages up for renewal in 2025 and 2026 had been renewed in recent years with shorter terms, anticipating a decline in interest rates. This strategy seems to be paying off as not everyone will face higher rates upon renewal. In fact, a significant portion will transition from higher rates to lower ones. The Bank of Canada's recent rate cuts have shifted the focus from the mortgage payment shocks experienced by many to a more competitive landscape for renewals. Analysts suggest that about 55% of all mortgages with Canadian banks will be renewed in the next 2 fiscal years, with 85% expected over the next 3 years. This influx of renewals is likely to spark intense competition among banks as they vie for a larger share of the market. McKay expressed that the Royal Bank of Canada has been on the defensive for the past 2 years due to its absorption of HSBC. However, with this integration now complete, the bank is ready to go on the offensive with an expanded sales force. McKay emphasized their eagerness to capitalize on the upcoming opportunities in the mortgage market. Toronto-Dominion Bank has also ramped up its efforts by investing in mortgage specialists across its branches. Chun anticipates a very active renewal season and aims to grow profitably while capturing more market share. Some experts believe that the restrictions on TD's growth in the United States may push the bank to be more aggressive within Canada. Victor Dowdig, Chief Executive Officer of the Canadian Imperial Bank of Commerce, shared that his bank expects to renew over 200,000 mortgages annually for the next 3 years. CIBC is confident in its high renewal rates and has implemented processes to engage clients well before their renewal dates. They have also invested in digital solutions to enhance the client experience. As we look ahead, the competition for mortgage renewals is set to intensify, offering potential benefits to consumers in terms of better rates and services. However, it also highlights the need for borrowers to be proactive in understanding their options and negotiating the best terms possible. This dynamic environment underscores the importance of staying informed and seeking professional advice when navigating mortgage renewals. Let's turn our attention to the Greater Toronto Area, where a combination of falling interest rates and rising inventory is presenting what some analysts are calling a positive double whammy for homebuyers. Jason Mercer, the chief market analyst for the Toronto Regional Real Estate Board, recently shared his insights on the current housing outlook for Toronto in 2025. According to Mercer, homebuyers, particularly those interested in condos, have entered the market from a position of strength thanks to a surge in new condo listings last year that far outpaced sales. In an interview with BNN Bloomberg, Mercer explained that the increased inventory has given buyers more leverage, allowing them to negotiate better deals. He mentioned that this trend is likely to continue into the first half of 2025. Buyers who were active in the marketplace were able to take advantage of that extra negotiation power, Mercer said. First-time buyers who are starting to move off the sidelines are going to take advantage of that sort of positive double whammy of downward trending borrowing costs and negotiating power in terms of their purchase. The Toronto Regional Real Estate Board recently released its 2024 sales and inventory data, revealing that overall home sales in the Toronto area increased by 2.6%, while new listings rose by 16.4%. The combined average selling price for all home types was reported at $1,117,600 in 2024, which marks a decline of less than 1% compared to 2023. Despite affordability concerns, Mercer noted that recent interest rate cuts by the Bank of Canada have helped ease some financial pressure, leading to increased activity toward the end of last year. Mercer also pointed out that although there was an uptick in activity in the fourth quarter of 2024, there are still many buyers waiting to see further action from the Bank of Canada. Our polling suggests that there are buyers out there with every intention of purchasing a home in 2025, but they need to see maybe another 100 or 150 basis points in cuts before pulling the trigger, he explained. Despite the rise in condo inventory, the market for single-family homes remains tight, with fewer available properties. Mercer emphasized the importance of continuing efforts to remove barriers for developers to build more homes quickly, noting the need to keep up with strong population growth in the Greater Toronto Area. Ultimately, we are going to absorb that standing inventory we have right now, and we're going to need to see that pipeline of supply pick up, he said. In Toronto, the real estate market has faced a challenging year, with home prices remaining largely stagnant despite a significant increase in available listings. The Toronto Regional Real Estate Board's recent report highlights that while there was a considerable uptick in the number of properties for sale, many of these homes remained unsold, particularly in the condo segment. Last year, Toronto's residential sales numbers hit some of the lowest levels seen in decades, driven in part by a struggling condo market. The number of condo units sold dropped to the worst level in about 27 years over the summer, leading to an oversupply that gave buyers more negotiating power. However, this did little to move the needle on overall home prices. The TRREB report indicates that, despite the sluggish market, the average price for a home in the Greater Toronto Area declined by less than 1% between 2023 and 2024. This was supported by lower interest rates, which helped ease costs for potential buyers, encouraging some to enter the market. Despite this, the number of homes sold was significantly outpaced by the number of new listings, which surged by 16.4% over the previous year. Ground-oriented housing segments saw tighter market conditions, which helped maintain their selling prices. In contrast, price declines were more pronounced in the condo market, where many first-time buyers remained hesitant, waiting for further interest rate cuts in 2025. This hesitation impacted the more affordable condo segment more than the single-family home segments. Despite a challenging year for the Toronto real estate market, there was a slight increase in overall home sales in 2024 compared to the previous year, with 2.6% more homes changing hands. Yet, this figure is overshadowed by the influx of new listings, totaling 166,121 compared to 67,610 sales. The Tarabee's analysis points out that while there was increased affordability due to technically lower home prices, the stagnant price movement leaves questions about what might drive prices down more significantly. Even with new condo sales dropping sharply, average prices for unsold units only softened slightly by 2.4% per square foot, highlighting the market's resilience despite lower sales volumes. December was a challenging month for the Greater Toronto real estate market, with sales figures and inventory levels painting a less than optimistic picture. According to data from the Toronto Regional Real Estate Board, the real estate market struggled to maintain momentum, leading to one of the weakest Decembers in over a decade in terms of sales. At the same time, inventory levels climbed to nearly record highs, signaling a potential shift in market dynamics. The price of a composite benchmark home in the Greater Toronto region was $1.06 million in December, showing virtually no change from the previous month. This stagnation was unexpected, especially after a modest 0.1% growth in November, which had marked the first monthly increase in half a year. While the prices remain relatively stable compared to 2021 levels, this follows a period of significant price increases that had positioned Toronto amongst the hottest real estate markets globally. On a more positive note, annual growth for home prices in the Greater Toronto Area has returned to positive territory, albeit modestly. Prices are now 0.15% higher than they were in the same month last year. However, it's important to note that prices are still 19.6% below the peak reached in March 2022, highlighting the volatility and recent corrections in the market. Despite the anticipation surrounding rate cuts, which helped fuel growth in November, the actual cuts in December failed to sustain buyer interest. The board reported 3,359 homes sold through the multiple listing service in December, marking a 1.8% decline from the previous year. December is typically a slow month for sales, but this was the second worst December for sales in at least 10 years, only surpassed by December 2022, which followed the initial rate hikes. In terms of inventory, December saw a 20.2% increase in new listings, with 4,681 homes entering the market. This growth in listings, despite a traditionally slow month for sellers, contributed to a significant increase in active listings, reaching 15,393 homes for sale. This represents a 48.5% increase from the previous year and is the second highest level of inventory seen in a decade. The data suggests that while there was some optimism leading up to the rate cuts, the combination of weak sales and high inventory levels has dampened market expectations. Prices did not advance, and the second worst sales figures in a decade, coupled with a near record number of listings, do not present a particularly bullish outlook for the market. The Greater Toronto real estate market continues to navigate these challenges, with stakeholders closely watching for any signs of a shift in trends. Canada's rental market continues to be a significant challenge for those aiming to become first-time homebuyers, with ever-increasing rental costs creating a substantial barrier to saving for a down payment. Despite a slight easing in rental pressures during the fall, the overall outlook remains grim, as highlighted in a recent study by the Canada Mortgage and Housing Corporation, CMHC. According to the CMHC's Fall Rental Market Report, rent growth slowed in most census metropolitan areas throughout 2024. However, new tenants faced a daunting 23.5% increase in rental costs. This rise comes despite a surge in supply, which remains well below the 10-year averages, indicating that the market is still under significant strain. Tanya Barraza Ochoa, CMHC's deputy chief economist, pointed out that although there is some market easing, it primarily affects newer and more expensive units. She explained to Canadian Mortgage Professional that while this new supply alleviates some pressure, many of these units remain out of reach for average renters. This new supply is definitely contributing to some easing, but for many renters, a lot of these newer units are just simply unaffordable, she said. It does help to alleviate some pressures for the higher income, or even to some extent medium income renters. But in the end, affordability challenges are still very persistent. The report also noted that slower rent growth has not translated into improved affordability, as rents continue to increase faster than wages, particularly for the 25 to 44-year-old renting demographic. However, Barasa Ochoa did highlight a potential long-term positive, the filtering effect. This phenomenon involves transitioning housing units from higher-income households to lower-income ones as newer units become available. The filtering effect technically says that by adding these units to the market, even if more expensive, in the longer run these units will contribute to more affordable markets, she explained. In terms of current rental costs, the average rent for a two-bedroom unit in the purpose-built rental market was reported at $1,447, while in the condo market, it was significantly higher at $2,199. Vacancy rates were 2.2% for purpose-built rentals and a mere 0.9% for condos. With nearly 140,000 purpose-built rental units under construction, more supply is expected to enter the market in 2025, offering a glimmer of hope for future affordability improvements. Despite a reduction in overall rent price growth from 8% in 2023 to 5.4% in 2024, rent increases continue to outpace other cost areas, such as non-shelter expenses. Barasa Ochoa emphasized that, in the short term, in the medium term, those affordability challenges are still very, very persistent. Further highlighting the financial strain on renters, the CMHC report revealed that rent arrears, although slightly reduced year over year, remain significantly higher than mortgage arrears. This disparity indicates that renters are feeling more financial stress than homeowners. Rent arrears were notably high in Ontario, one of the most expensive provinces for rent in Canada, with approximately 180,000 units currently in arrears. Barasa Ochoa remarked on the significant financial pressure renters face compared to homeowners, noting, "When you're looking at other credit products specifically for renters, there are a lot of signs there too that financial pressure and stress are being felt. While the increase in supply is a positive development for the long term, the immediate outlook remains challenging, with financial stress continuing to impact renters across the country." In our final segment today, we're taking a closer look at the latest initiative from Glasslake Funding, a Canadian alternative lender known for its flexible financing solutions. They've just rolled out a new rewards program called WaveMakers, aimed at recognizing and incentivizing high-performing mortgage brokers. This program, launched at the start of the year, offers brokers a range of exclusive benefits and tools designed to streamline their operations and achieve greater success in 2025. At the heart of the WaveMakers program is the Million a Month Club, which rewards brokers who are able to fund $1 million or more in deals every month. Brokers who reach this milestone can look forward to faster service times, more competitive pricing options, and financial perks intended to enhance their relationships with clients. Mike Forshee, the president and managing director of Glasslake Funding, emphasized that the program is about more than just competitive compensation. Speed is crucial for brokers and their clients. Pricing adjustments can make a significant difference in today's market, he explained. The WaveMakers initiative is designed to combine speed, service, additional compensation, and marketing opportunities to help brokers stand out and excel. The program operates on 3 levels of achievement, each offering progressively more perks. The first tier, Wave 1, rewards brokers who fund over $1 million with a 48-hour service commitment, a 25 basis points rate reduction on 2 closings, and a $500 contribution toward an appraisal. Wave 2 steps up the benefits for brokers funding over $5 million with a 24-hour service commitment, a 25 basis points rate reduction on 4 closings, and a $1,000 finder's fee for 1 funded commercial deal. Finally, Wave 3, aimed at those funding over $10 million, offers a 4-hour service commitment, a 50 basis points rate reduction on 3 closings, and a $1,500 finder's fee for 1 funded commercial or residential deal. According to a news release from Glasslake Funding, these tiers will evolve over time, with new rewards like sponsorship opportunities and marketing funds to be added in future updates. The program emphasizes supporting brokers in enhancing their business capabilities. Ruvani Henriquez, Vice President of Strategy, Sales, and Marketing at Glasslake Funding, stated, WaveMakers is all about listening to brokers and rewarding their support with tools that help run, scale, and enhance their business, especially when they're consistently making waves of funding each month. This initiative by Glasslake Funding represents a significant step in supporting brokers' growth and success in the competitive mortgage landscape. It's an exciting development for those in the industry, providing both recognition and tangible benefits to high-achieving professionals. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.